Hey, Money Multipliers! Welcome back to another episode of the Money Multiplier Podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? So today I invite you, get comfy. I'm going to be getting comfy here. I'm excited to be back in my studio. I know it's been a little bit. You've been seeing a lot of guest episodes pop on here. And it's just been because I've been on the road. I've been traveling a lot. And so since I've been on the road, I've gotten a lot of interesting text messages. Some things that have not been great. I don't know if great's the right word, but just some folks who are not understanding the power of their whole life insurance policy. And here recently, I was invited to go and speak on the stage of OneAmerica, which is an insurance company that we do business with, one of our 5 companies. I would say they are probably one of my most favorite to be a client of. So out of my 7 policies, I hold 4 of them with the company OneAmerica. And they invited me to come and speak on stage because they wanted my perspective of, how are we running our organization over here and sharing powerful information with my peers and colleagues. And I was able to go and share what we're doing within our company from the business side. And there was a gentleman up on stage, Mr. OneAmerica. Shout out Mr. Clay Summers. If y'all are coming down to my mastermind event, that's happening in 2 days. October 10th is in 2 days, everybody. I'm so excited to see all of y'all. But you will have the pleasure of meeting Clay Summers. Phenomenal guy. But he was up there on stage talking about, does my death benefit really matter? And he really drove it home because I know a lot of the times we're talking about, cash value, building wealth, the living benefits of your whole life policy, which is very, very important. But one thing that we don't spend a lot of time talking about is the death benefit. And death benefit is important. I know death benefit can kind of get a negative connotation to it because, it's just for death. Why would I be putting money away when I want to use my money today? And why would I leave it to my ungrateful children and my family? Being extreme here. But I really want to talk about, is my death benefit really important and does it matter to me? Or what some of y'all like to tell me, Hannah, I don't need death benefit. So before we get into this, I wanted to share a text message from a client that I received while I was on the road traveling. And I also want to share too, I actually had the pleasure of interviewing Mr. Rudy Giuliani. He was the mayor of New York City during the time of 9/11. He was Donald Trump's attorney. I believe still is his attorney. I don't know. You have to go fact check me on that. But, he's a politician and he was able to share a lot of good, interesting perspectives that really kind of align with this topic that I want to share with y'all. So sit back, get comfy with me, grab your favorite beverage, and without further ado, let's get into the episode. All right, pardon the interruption, but I woke up this morning and I got a message from one of my people, a Money Multiplier member. And he messaged me on Facebook and his baby boy just got delivered yesterday. So he was asking me, he says, Hannah, can we get a policy started? Can we get rolling on that application? And I said, hold on. We first got to wait for the Social Security card to come through the mail. And then I don't even know how that works. I got to get educated on that. Like he's on active duty. And so he's overseas right now, him and his wife. And so if a baby gets delivered overseas, but the parents are U.S. citizens, does that automatically make the child a U.S. citizen? I don't know. I had to ask him all those questions. I was like, part of my ignorance, I just don't know. But then it got me thinking. He wants to put this policy on his baby boy because, they want to use it for wealth building. Maybe they want to send him to private school or use for the future for his first apartment, first car, right? Use for college education. So they want to use it for that. But then it also got me thinking about the importance of the death benefit, because God forbid if something were to happen to him during his youth and it becomes uninsurable,
he's not going to be able to qualify for any more policies moving forward. Because then it got me thinking about another client of mine where her sister, I want to say she was 13 years old. She got hit by a car and now she has traumatic brain injury, and none of the insurance companies will consider her for a policy because of that incident that happened. And they got these checks rolling in from a settlement way back in the day, just based on that judgment or whatever. They are now getting these monies that roll in so often, and they want to have a place to warehouse that money instead of just like a high yield savings account or a CD where they're locking up the money at. And they really want it on her, the sister who's now disabled, but they can't get it because that sister is going to pass, and they're spending all of this money in assisted living and hiring nurses to come out to the house. So they are sometimes taking out loans to fund for this. And if that sister were to pass, they still got these outstanding loans that need to be paid. And that's where a death benefit would come into play, where they can now pay off those debts. So anyways, it really got me thinking this morning. I thought it was an important message. I just want to share it with y'all. Let's get back to the episode.
So I want to start off by reading this text message that I received from somebody. So this has been a client of ours for probably the past 2 years. He's been around, and he sends me a text. And the reason that he sends me this text is because we got a notification from the insurance company saying that this individual recently requested surrender paperwork, that he told the insurance company, hey, I want to cancel my policy. Please help me cancel this. And so when something like that happens, they notify the agent. And so we got a notification from the company, and that's when it kind of sparks us to say, okay, well, what's going on? We just had the conversation about 2 months ago, because as y'all know, being clients of the Money Multiplier, the team is checking in with you every single quarter, and we're just checking in. Hey, how's life going? Do you need my help? Do you need my support? Do we need to schedule like a quick meeting? And I found it odd because just about 2 months ago, there were notes from my team saying that, hey, spoke with this person and all is going well. And they just had some questions over, their policy loans. And hey, is this a good way to use my cash value? Here's some things that are going on within my life and within my business. So I check in with them. When I get that notification, I give them a call, I send them a text message, and I get a text message back saying, hi, Hannah, I'm fine. I found a real estate investment where I get 10% or more return, in parentheses, not based on the Fed interest rate. So I decided to close my policy. For my kids, I have given them some money now, which they needed, and I will pass on some property to them when I die. And I'm going to retire soon, so things are fine with me. I don't need my death benefit. They got me thinking, this gentleman really doesn't understand the infinite banking concept, because if you truly understand this concept, number one, which I'm not going to spend time talking about today because I talk about it all the time, you understand that your policy is not the either or asset. It's the and asset. I'm going to run my money through the policy first, and then I'll go make my investments, because I'm in the same boat as this person. Hey, I do real estate investments. That's what I like to do. That's what I like, know, and understand. But the reason I'm using my policy cash is because now I'm double dipping on my money, making the interest uninterrupted compounding in the policy, and I'm making interest over here in the lending deals that I'm doing. So number one, we don't understand that. So we have to go back and do some education. And let me just do a big PSA. Y'all, it is your responsibility and your duty to take control of your financial life. Tune in to my weekly podcast show. Tune in to the weekly webinars that we're doing, the live events that we have going on around the country. It is your duty to really show up for yourself. You can only lead the horse to water, but you can't make it drink. I can show up 80% of the way to you, but it's your responsibility to fulfill that remaining 20%, because this is about you and your financial life and your financial health. So that's number one. But the biggest reason of why I wanted to talk about this is he goes, I don't need my death benefit. I want to share a quote from Rudy Giuliani, and I'm going to post a picture up here on my YouTube channel. So for my folks seeing me on YouTube, check out this image. This was me having the pleasure to interview Rudy Giuliani. And in this interview, he talks about all life is special. All life should be protected and all life should be taken care of. That got me thinking about death benefit and the importance of death benefit. Now, Mr. Clay Summers, when he was up there speaking on stage at the insurance company, he was going through examples. And I'm going to be reading this through my notes here. He was talking about, using examples of your car insurance, your house and homeowners insurance. And he was talking about how much is your car really worth? And when you go out there and you get insurance for your car or for your home, are you going to insure your car just for the minimal amount possible? Or are you going to insure it to that true value that it's actually worth? Because in the event that you get into a car accident and you completely total that car, are you going to want to have the insurance that's going to replace that automobile that you have, or your home insurance to replace the home that you are currently living in? Or are you going to get just the minimal amount possible that's required for you? And I get it. Some of the folks that you're thinking, well, Hannah, I'm just going to get the minimal amount possible. Okay, that's your provocative, whatever that word is. That is your opportunity to go do whatever you want because you are in control of that, which is fine. But when you are in that dire need situation, are you going to be thankful because you got the minimal amount of insurance possible? Or are you going to be thinking to yourself, oh my gosh, I am so happy that I got the most amount of insurance that I possibly could get because I need this money now? And most of y'all are thinking, well, hey, I need this money. And so how much money would you want from the insurance company to replace this asset that you have? And most of the time, you're going to think to yourself, well, I want the most amount of insurance that I can get because in the event something like that were to happen, I'm going to want these resources to replace that asset that I had in the event of a accident or something happening. So I want y'all to really follow along with me because there is, just how on a car or a house, you have a maximum insurability on your body. And now go check out my other episode where I talk about how is your insurability calculated in the underwriter's eyes at the life insurance company. But I want to share this other resource with you because everybody has an economic life value. And how the insurance companies are finding this is they take into consideration all of the moving parts of your life. They look at your income, your assets, your health, your criminal history, your social history, your family history. They take in all of these moving parts and they say, Hannah Kessler, you are worth X amount of dollars. And I know it sounds crappy when I put it that way, but we all have an economic life value. So I want to share this tool with you. Now, I want y'all to go to OneAmericacom. So OneAmericacom. And it starts you here on your homepage. What I want y'all to do is in the task bar up at the top, I want you to hover over 4 individuals. And when you hover over 4 individuals, I want you to go to life insurance products. When you go to life insurance products, it redirects you to this new page. I want you to scroll down and I want you to look at whole life insurance. And we're going to click on this button here, learn more. When I click on learn more, it then takes me to a new page. And we're going to scroll down just a little bit until this yellow box down here. And we're going to click on Economic Life Value Calculator. When I click on that, another window opens and it says, how much life insurance do you need? Life insurance can replace some or all of the income and other contributions you make to your family in the event you're no longer around. You can more accurately estimate how much life insurance you may need when you know your economic life value. The calculator below shows 3 methods of approximating your economic life value. So let's just kind of go through here, and I want to complete this because, there is a need. When you think about it, and I know this is not topics that we want to think about, it kind of falls into the line of like estate planning and creating your wills and your testaments and your trusts within your family. But this is the reason that life insurance was created, for the terms of the death benefits, that in the event of a premature death, your family is going to be taken care of when you are no longer here. Me, if I had a spouse and I was the primary breadwinner of the family and something were to happen to me, my family is going to need those resources in the funds in the event that I'm no longer here, because they are going to have to sustain this lifestyle that they are living now. That my family and my children, they're going to need this when they need to take some time off. They are grieving, they can't go to work, they need to really be present with themselves and get over this hurdle of death, because it's hard. If you have never experienced death within your family before, it is a hard concept to grasp. And so I want to walk through calculating your economic life value. So if I was the type of person, let's say we're going to select your age. Let's use my age. Let's use the age of 25. So I select the age of 25 and I'm going to enter my targeted retirement age. Let's say my targeted retirement age is age 60. Now, to be honest with you, I'm kind of like Nelson Nash. I don't believe in the word retirement, because when you retire, you stop serving God's children. But there's going to be days where, I don't want to be working every single day, 12-hour days, right? I'm going to want to take some time off and do the things that bring me joy and not really be working in my business as much. So we're just going to say my targeted retirement age is the age of 60. And let's just make believe that my current income right now, let's just say it's $100,000. That is my current income right now, making up numbers. So when I click here on this calculate button, it shows me these results of different economic life values that the insurance company will insure me up to. One of them being my income factor. Your income factor is the product of your current income and a default income factor. Income factors use historical life insurance data and project economic conditions, aka inflation. Ask your financial professional for more information about adjusting your income factor to your specific situation. And again, this guideline of the income factor, this is going to change as time goes on, because hopefully my income keeps rising, that I'm going to need more and more death benefit as time rolls on. So based on these calculations alone, this is telling me that I'm going to need $3 million of death benefit to make sure that my family is protected when they lose my income that's coming in. They got another one, income potential. This straightforward calculation estimates your lifetime income potential by multiplying the number of years until you retire by your annual income. And this is telling me 3.5 million. This kind of gets into the world of, using the policies, your whole life policy, to supplement income during those retirement years. And how much am I going to need to keep sustaining my income during my retirement years? Because I mentioned before, I don't got any retirement plans. It's really my whole life policies. That is what I'm going to be using to supplement my income during those retirement stages. And so this income potential is showing us, okay, how much death benefit am I going to need at the time of those retirement years to keep sustaining my income that I'm producing now. They also got another one that's labeled income analysis. And this is the one that normally life insurance professionals are not using as much. They normally use the income factor and income potential. But another one is dividing your current income by a standard withdrawal rate shows what it would take your family to withdraw an amount of money similar to your present income. And it kind of plays hand in hand with the income potential. And this one, it's telling me 2.5 million. So these three factors, the insurance company takes into consideration how much life insurance that you're going to need on your body to keep allowing them to sustain the lifestyle that you're living right now and the lifestyle that they will keep being able to continue on with in the event that you were to pass prematurely. And that's the fun thing about whole life insurance, permanent insurance, is that, this policy is going to be in force until I'm age 121. That's the permanent aspect of it, is that it is going to be in force for my whole entire life. So I want y'all to really go on here and play with this economic life value calculator, because you'll notice a lot of y'all, you guys are probably uninsured right now. Underinsured, I should say, not uninsured, underinsured. Because you guys have this death benefit on you, which is great. It's coming from your whole life banking policies. But some of y'all, it may be a good idea, especially if you're in risky fields. Maybe you are a bounty hunter or a firefighter or a police officer, and you are putting your life in jeopardy every single day showing up to work, that it is important to have this death benefit on you. And that's why sometimes I encourage my folks, and I should probably be doing a better job of this, of telling y'all that, hey, you guys are underinsured right now. You only have $500,000 on your body, but you should have $3 million of death benefit on you. And some of y'all are probably thinking to yourself, well, Hannah, I'm okay with $500,000. I really don't need all of this death benefit. Well, take it back to the car example and the house example. Are you going to insure your car, your house up to what you think you need, or the true value that it's actually worth? Because in the event that something were to happen, you are going to need these resources to keep sustaining your family's lifestyle. And most of us, some of us can be selfish, but most of us are doing this not for ourselves, but for our children, our spouse, or grandchildren. And it's important to have that generational legacy and wealth within your family. So I want y'all to really explore this economic life value calculator, and it may be a good idea that, okay, maybe you're not in the position that you are ready to start another whole life banking policy right now, but this is where there's other vehicles out there, like a convertible term policy could make sense. Sometimes I have some folks who will go through the underwriting process for their whole life policy. They get approved, and then something dramatic happens that they just can't start their whole life policy right now. So I'll tell them, hey, since you've already went through the motions of getting approved for your whole life policy, and I know it's time consuming, and it takes about 4 weeks to do this. You got to go in and do your own legwork with completing the application, doing the medical exam with the insurance company, that don't lose this approval that you have. I mean, matter of fact, I've had some folks come through underwriting, did not take their policy, and then they come back a year later wanting to get approved for the policy again, because there's an expiration date on when these policy offers do expire, and they can't get approved for the policy now because something in their medical history came up recently that the insurance companies are going to postpone them. I've even had people, and knock on wood, this is a very sad story, where he passed away during the underwriting process, and his family was not taken care of. Now they got all these medical bills. They're in a crap load of debt. They got this house that's not paid off. They got student loans and all this other crap, and it all falls on their spouse or their family members to take care of and clean up this mess. And so convertible term can make sense for a lot of people, and it's just the term insurance that we all know about. It's term, it's cheap, we like it. No, it does not build us up cash value, and it's just renting that death benefit for that term or that set amount of time. But the convertible aspect of it is you can convert the term into a permanent whole life policy and not have to do any of the underwriting process for it. I mean, God forbid, if I were to go out and get breast cancer in my life and I simply cannot qualify for any more policies in the future, if I have this convertible term policy, it locks in that insurability that no matter if something comes up in my health, I am able to convert this term into whole life and not have to do any underwriting for it because I've already locked in the insurability. So death benefit is important, and y'all need to really be taking into consideration death benefit a lot more and better than what you guys really think that it is doing for you right now. Because when I graduate or pass away, I am going to leave my family with my cash flowing assets and my other assets that I have. And I'm going to leave this lump sum tax-free death benefit at the time of my passing. And that's where I want to teach them about privatized banking so that then they will take this death benefit. They will go pay off maybe some debts that I have. Because reminder, not all debt is bad debt, but they'll go and clear off some of those debts. Maybe they'll use some of it to start more policies. That is my biggest goal and hope for y'all is that you are now taking this death benefit, teaching the family correctly so that when the time does come to, need or we graduate, I should say, or pass away or die, that they will now take this death benefit. They understand it privatized banking, keeping money in the family, that they will take this money and start more banking policies, and it just trembles on from there. It's just an ever-increasing flow of money, keeping it within the family, because I don't want the banks to get my money. I don't want the government to take my money. I don't want my stuff going to probate courts. And that's why it's so important to have all of these, estate planning, my wills and my testaments, my trusts in place, that I get to dictate what happens with my money when I'm no longer here, instead of leaving it up to other people who don't really have the best interests of myself and my family. So all life is special. All life should be protected, and all life should be taken care of. And we are the happiest when we are contributing. That was another line that Rudy Giuliani said. We are the happiest when we are contributing to our families, ourselves, and to other people. Don't just walk down this life being selfish, and then you end up at the end of the time thinking, oh my gosh, I should have prepped for this a lot more than what I did. Because I know I've talked about it a little bit on my show, but even in my own family, I have my grandparents that did not prep for the times of medical needs, when they get older, and the cost of assisted living and having nurses come in and take care of them because they can't do it. They're just not cognitively there, or they mobily cannot do it. They can't do the activities of daily living like bathing, eating, the mobility, etc. So it's important to have these things in place. But one thing that this gentleman did say is that for my kids, I've given them some money now, which they needed, and I will pass on some property to them when I die, which is fabulous. And I'm doing the same damn thing over here. But in addition to all of those assets that I've acquired through my whole life insurance policies, using it to become my own banker, I'm also giving them the death benefit at the time of my passing. So y'all, stop it. Stop it with that narrow thinking and mindset. You're going to need this whether you like to admit it right now or not. And it's fine. If you got different philosophies around it, I get it. But I'm telling you right now, you don't get this. You really don't get this if you are putting so much emphasis on the other insurance that's potentially and hypothetically that could happen in your life, and you're neglecting the insurance that's actually guaranteed to happen. Oh my gosh, I just remember this one time I was down at Lake of the Ozarks, or spending some time there over the summer, and my father walks into my office one day. And I'm in the middle of doing something on my computer, and he just barges in, opens up the door, and almost like slams against the hinges. And he goes, "Hannah, I just don't get it. I don't get it. People neglect the insurance that's actually guaranteed to happen, but they will spend buku bucks on the insurance that's the hypotheticals. My flood insurance, my fire insurance, my car insurance, all of these other crappy ass insurances that are hypothetically could happen, and they neglect the insurance that should actually happen and will happen, I should say." But another point he kind of brings up too is he says, "Well, Hannah, I found a real estate investment where I get 10% or more return, and it's not based on the Fed interest rate. So I decided to close out my policy because I don't need this." Number one, I'm going to go on a little tangent here, and some of y'all may turn me off, and that's fine. It's okay. But I really want y'all to get this, because this is something that we do not talk about a whole lot. You guys think that when you put money into the bank or other investments, or storing money in your 401k, the market, you guys think that your money is protected within there because of the Fed and what the Federal Reserve is setting for themselves at the local banks. Hannah, I am okay to keep my money in my bank accounts doing whatever, because Hannah, if something were to happen from the FDIC insurance, I am insured up to $250,000. Really? I thought about this too. This was actually after this gentleman sent me this text message. I was walking down the streets of New York City. I was walking up to my Jumbotron image that was going to be displayed in New York City Times Square. And I want to post up a picture of this right now on my YouTube. Isn't that freaking cool? I mean, look at that. I actually had a Jumbotron image in New York City Times Square where there were thousands of people walking around. And I was holding up Nelson Nash's book, Becoming Your Own Banker. And you see me in my Do Your Dollars Make Sense shirt. And I got a lot of people talking to me about banking because they looked up the book, they looked up my name, they got exposed to my podcast show. And I was walking down the street with one of my maybe a close friend, a guy in my mastermind group. He's older than myself. And he goes, "But Hannah, insurance companies are not backed up by the FDIC like banks are. There's no FDIC insurance when it comes to me putting my money inside of these whole life insurance policies." Well, let's think about it. I want you to go and read the book, The Creature of Jekyll Island, by a guy named Griffith. I'm blanking on his first name right now, but Griffith is his last name. And it's a big book. It is a hard read, so I recommend getting it on Audible. But in there, it talks all about the creation of the Federal Reserve System. And it talks about how FDIC insurance is the biggest scam in a marketing term if I ever did hear one. Because you know what the FDIC insurance really is? It is turning on the printing press in the back door of the Federal Reserve System when a bank is going belly up. When there comes a time, because it happens, it just happened last year, 2023, with Silicon Valley Signature Bank. You know, there was a time where these banks were going belly up because, you know, people were going and doing a run on the bank, or they made some bad investments, and the borrowers that these bankers lended out their money to, they just didn't have enough to pay the banker back each month their monthly payment. So what they did is they said, hey, well, we don't want to see uproar in the streets. So what we're going to do is we're going to turn on our printing press in the back door, and we are going to give these banks this money to bail them out so that they can replenish the accounts of their holders and their depositors, so that when they need the money, they can go in there and there's money there that they can now get out. And that's all it is. You know, these bankers are playing this game of the fractional reserve lending game. Well, I hope and I think that not everybody's going to come and do a run on the banks and request all of their money out at one given point in time. And so what they do is they will take our money. When we deposit $1 there at the bank, they now lend out anywhere from $8, $9, $10 for the $1 that we hold backhand on their reserves. And y'all, go look at this. There's actually not even requirements now for bankers to even hold any money on their reserves. This happened right at the beginning of the COVID times, where the Fed posted out that, hey, these banks got to have 0% money in their reserves, and they are compliant with us. And so then if a bank goes belly up, what the Fed will do is they will open up their back doors, turn on that printing press, and then they will go and bail the banks out, because they don't want to see the uproar in the streets of the people getting angry and mad with them because they don't have their money. Well, I trusted you. You should have had my money here. That's why I'm making these deposits into your bank. And most of us just do it because we've never been taught that there's a better place to warehouse the money. So they turn on the printing press and they say, hey, here's the money. We're going to bail you out. And now it just comes back on the American taxpayers' backs. And it's now us paying all of this back to the Fed in the form of tax money and the hidden tax that we like to call inflation. So these banks are not technically backed up by the FDIC. Yeah, you can think they are, because the Fed will just go in and turn on that printing press, but they're not, because it's truly hurting us, because our dollar is not tied to anything anymore. It's all fiat currency that's circulating around the system. That's one of the biggest things that we need to do is, number one, I think we need to abolish the banks, but then number two, we need to tie the money back to the gold standard, because then it actually becomes relevant to what that currency actually holds in meaning of value. Because if it's not tied to anything, that's exactly what the Fed can do. They can just print. And that's why we see all of this cost of living keep increasing as time goes on. And so the biggest misconception when it comes to the insurance company is, well, Hannah, my money's really not safe because it's not backed up by anything like the FDIC is. No, it is. And I want y'all to look into this. It's something called the Insurance Guarantee Association. That's this entity governs insurance companies on a monthly basis, and they come out with what's called Comdex scores and the Comdex reports, COM as in Mary, DEX, Comdex. And this is public information. You can just go Google this. It's a monthly report that gets sent out, and it really compares the insurance companies to the other companies that are out there in the marketplace, and they are seeing how well these insurance companies are doing compared to the other people in their field. And if there comes a time where a bank is going belly up, what will happen is this insurance guarantee association will come in order for that company to be bought out from another larger insurance company, somebody else that's there to bail them out. And I don't want to say the word bail them out, that's not really what they do, but they basically purchase them, they take them over. And then it comes into that new leadership. And worst thing that could ever happen, and it's never happened. Go look this stuff up. I mean, life insurance has been around longer than our tax code's even been here. Whole life insurance has been around longer than 1913. And so it's never happened that nobody has ever lost money in a whole life insurance contract. So what will happen is that if a company does start to go belly up, or maybe they trend in the terms of getting demutualized because they are going belly up, and a larger stock held company is going to come in and purchase them out, they will be bought out. Yeah, maybe it's a stock held company, but this is all contract law. At the end of the day, these insurance companies, they need to follow the guidelines of that contractual agreement with their policy holder. Because let's think about it. The whole reason that we're building a banking system on a whole life insurance contract and not vehicles like an IUL policy, a 401k, a VUL, term insurance that doesn't even have equity inside of it, but the reason that we're using whole life is because of the guarantees that come with inside of that whole life insurance contract. It comes with my guaranteed interest that no matter what's going on in the world, the insurance company has to pay me this guaranteed interest, and they have to pay me this guaranteed death benefit. As long as I keep up my ends of the contract, paying my base premium in that policy and keeping that contract alive, paying my premiums on time and the minimum that's required at least every single year. So no, these companies are not backed up by the FDIC in that traditional sense that we've all been brainwashed to think that could be good for us. But it's backed up by so much more, by contractual obligations that the insurance company has to keep. Because what's happening is we're pushing the risk back on the insurance company rather than it coming back on to us. As long as I pay my premiums, I got to get my guaranteed interest and I got to get my guaranteed death benefit. So I want y'all to think about this. How much death benefit do you have on your body? And this is my big PSA as well. If you have not tuned into your policies here recently, go and update some of your stuff. Maybe you went through a divorce. Maybe you got business partners or a trust into place, and you need to go in there and update your owner or even the beneficiary on your policy. Make sure you update these items, because there was actually an incident where somebody did pass away, one of our clients. And he went through a divorce not too long ago. It was about a year prior to him passing away. And his wife calls us up almost frantic like, saying, hey, who is the who is the beneficiary on this policy? Because she was nervous that the death benefit was still tied to his ex-wife, and she was nervous she wasn't going to see any of these death benefit money when it was them who kept paying these premiums. So make sure you are looking at your policies, monitoring them, and updating those things, because in the time that it is really necessary and needed, you're going to want to make sure that you have all of your ducks in a row, because it can be too late. If you were to pass and you have your beneficiary listed as your ex-spouse, and you and your ex-spouse just don't get along and they will steal from you, not to get into all the family drama crap, but I mean, it happens, right? You want to make sure that your family is taken care of. So my big PSA, if you get nothing else from my talk today, make sure that you are updating your beneficiaries, looking at your contracts on a ongoing basis. Once a year is fine when it comes to the death benefit proponent of it, but then also make sure that you are sticking with your economic value of how much you are actually worth, and you are insuring yourself up to that maximum death benefit potential. So those were just my big PSAs. It's been a pleasure. It's been a lot of fun these last few weeks traveling around, doing different things. I got a lot of cool episodes and guests that are in my queue right now that's going to be coming out. And reach out to me. Send me your questions. If there's things that you want me to be talking about more and more as we dive deeper into IBC, please let me know. And for all of my Nashville folks, I am so excited to see you. Happy October, everybody. I know last week's episode, actually, I had Mr. Clay Summers on, so kind of forgot about that. So y'all met Clay Summers if you tuned into last week's episode talking about the MEC limits and how the MEC changes and what proponents really calculates the MEC, the modified endowment contract of a policy. But I will see y'all in Nashville. Stay in tune to actually the following week. I'm going to be in Orlando at the annual Money Show event. Week after that, I think it's a down week for me. I'll still be here in Florida. And then I got some other things going on in November. Actually, right after Halloween, Chris Noggle and I are going to be at the annual Ohio RIA event in Mason, Ohio at the Great Wolf Lodge. Great Wolf Lodge is kind of an interesting venue. They have it there every single year, but let me be real, their hotel rooms are not my favorite. The beds in there are just so uncomfortable, but it's going to be good. I think this is going to be our 5th year going to the Ohio RIA, and it's going to be a lot of fun because it's going to be Chris Noggle and I really tag team in this. And then also, if I see you in person, you're going to see Mr. Joseph Kovacevic. Sorry, Joseph, I mispronounced your last name. Kovacek. I just pronounce it how it's spelled, Kovacevic. And Mr. Helock will be there live and in action, aka Mr. Joseph. But for all my people traveling into town to Nashville, I will see y'all in 2 days. We have the VIP pre-party Thursday night on the 10th. So all my VIP guests, it's going to be all of y'all plus all of the speakers there and their families. And then Friday and Saturday, jam-packed 2 days with content-filled days. Brent will be there, Chris, Craig Yenny, Jonah and Jeremiah Dew. Carson Hurling is going to be speaking for his first time, so give Carson a whole lot of love. It's going to be his first ever live speaking. It's going to be so much fun, and I'm going to be there doing some content and topics as well, along with emceeing the event with Mr. Stephen Nagy as well. So with that being said, I will catch y'all next week on the following episode. And please reach out to me. If you want some help on this economic value calculator, I am here. I challenge you, go to OneAmericacom, search up your numbers, and stay up to date with this stuff because nobody's going to care more about your financial life than what you do. So thank you, Money Multipliers. I will catch you next week for another episode. And until then, make good choices. Keep asking yourselves, do your dollars make sense? Catch everybody then. Bye, y'all.